Hello, welcome to day 5. Today it's going to be fundamental analysis, fundamental drivers of markets. So let's go and have a crack on of what we're going to be looking at. We're going to be looking at 3 key areas. Firstly, economic indicators. These are released by government or government agencies. Then we're going to be looking at company reporting, and finally government auctions. Economic indicators, of course, the main things we're going to be looking at will be macroeconomics, the actual economic releases, and of course what it's all about, where are the trading opportunities. Likewise, with companies and company reporting, we're going to be looking at earnings releases and then also M&A. This a very big area, but a very ad hoc kind of event. You can't necessarily predict it, but you need to know what you're going to do in that kind of event. And of course, trading opportunities, we'll have a few examples of where you can make a little bit of money trading some of these things. And finally, government auctions. I know we've mentioned these earlier, but we'll actually talk about what the direct market impact is, and of course, once again, trading opportunities. There will be examples throughout, and we'll be showing you them, some in video form, some just charts, and a little bit of price data action for you as well. So let's crack on. The economic indicators that we look at throughout the month are all concerned with macroeconomics. This is the aggregate supply and demand of goods within the economy. That's goods in the terms of labour can be seen as a good, as well as money. And it is all about the aggregate. Much like stock markets, it's the aggregate supply or demand of buyers and sellers that moves the market, not individuals' micro choices. And that's where the microeconomics element comes in. So really, we're concerned with 3 parts of macroeconomics, and all the other figures generally come to contribute to this. So first up, we've got GDP. This is a measure of all the goods within an economy and gives you a basis of how large the economy is. I'll give you an example. The US is the largest economy in the world. Their total GDP for 2016 was around about $18 trillion. So that's the value of everything in the economy. The key things that we're looking out for is the progression of GDP over time, and also if we start seeing any dip into the negative. 2 quarters of negative GDP are deemed as a recession. That's a technical recession. Now, whether there's other factors that you could essentially say a country is in a recession anyway is true, but when you actually see it, then the country is in a technical recession. This is where GDP number can be particularly good for trading, in that if you've had one negative quarter, the next one, whether that's negative or positive, should provide some pretty big trading opportunities. Next up, inflation. This is general increase of prices over time. Now, this is good and bad for certain people. It all depends on your position and your situation. If you've got quite a lot of debt, inflation's great, because your debt, say, is $1,000. As inflation rises, the $1,000 that you owe essentially is a lot less money. It becomes worth less. Your earnings will increase with inflation as well. So servicing that debt and paying it off becomes a lot easier. Conversely, if you've got a lot of savings, then all of that money you've got saved is progressively earning you, well, not earning you less and less, but is unable to buy the same amount of stuff that it used to. And this is where you get the real rates of inflation, so, and a real rate of interest. Your interest rate that you're getting on your savings, the real interest rate is your interest rate minus the inflation rate. So if you're earning 0.5% on your savings and the inflation rate is 2%, you're actually earning minus 1.5%, because whilst your savings grow by half each year, everything else is gaining by 2%. So that's where inflation plays a big factor. And that's why at varying parts of the business cycle, inflation is a good and a bad thing for different people and different markets. And finally, unemployment. This is, well, as it says, and as I'm sure you understand, unemployment is all about who is out of a job, but also those who are looking for jobs. Just because you're out of a job doesn't necessarily also make you entirely out of the jobs market, and there's various different measures of unemployment, and different countries look at it slightly differently. There's three types basically. Structural unemployment, this is where there's a mismatch between the skills that people have in an economy and the skills that are demanded. So say an increase in technology will put people out of work. We saw this in mining. You could start seeing this with an expansion of robotics and people having less need for service industry jobs. This then puts people out of work, and until either people can come in to fill those roles or people can reskill, then that structural unemployment will continue, and that could be the cause of an unemployment rate rise. Frictional unemployment, this is the just natural turnover of jobs. It's very rare that people leave a job and immediately get a new job. So that's where some degree of unemployment comes from. And that's not really something to be worried about. And then of course, cyclical unemployment. This comes from the economy, the peaks and troughs in the economy. As the economy enters a recession, companies, well, some go bust, some start laying people off to cut down costs, and that's where the cyclical unemployment comes from. And that's the one that's really going to give you an indication of how the economy is getting on. Now, if you want to stay up to date, and I do suggest that you should, particularly with the trends, it's easy to stay up to date with the figures as they come out each month, but the trend of how the figures have been changing is the important thing as well. Great website to have a look at, tradingeconomics.com. They have got historic data on virtually every figure you could think of for every country you can think of as well. So have a look on there. Fantastic website, gives you all the information you need. I'm not going to spend too long on macroeconomics and business cycles, reason being that understanding all of the finest nuances of macroeconomics and Keynesianism and monetarism and neoclassical economics is not necessarily going to help you actually make some money trading an inflation figure, an unemployment number. So we'll just give you some generalizations and things you should be thinking about in terms of the business cycle. So in a boom, what we get is we get some growth. This is spurred by perhaps technological advances, new discoveries, increases in productivity and efficiency of industries. What this does is this increases growth, building up of GDP. Now, Oken's law, this is, that states that as GDP rises, unemployment falls. So you've got an inverse relationship between unemployment and GDP. Now, as you get more growth, you get more demand for jobs. This is the pushing down of unemployment, but it also pushes up wages because people realise that they are in demand. They can now ask for greater wages. As the wages rise, then this money is then spent on goods within the economy. Increase in inflation, because you've got more money in the economy, is chasing more goods. If the goods can't be produced as quickly as people are earning money, then you start getting more and more inflation. Eventually, what you'll get is you'll then get a tailing off of this. Perhaps the demand for goods isn't as high. Perhaps these industries start faltering, various different reasons, but you then start to see this scaling back. And as you get a scaling back, and the inflation could increase the costs for some of these companies as well. So as you get the scaling back, the inflation starts to drop, people then start to get laid off. We become into a contraction, and following that, a recession if it does get bad. And this is what monetary policy is trying to affect, and we'll have a look at that in a moment. Now, what happens with a recession is that growth then starts to fall. As growth falls, unemployment drops because companies are not employing so many people. Inflation then drops as well, prices start falling, and you need then some kind of stimulative effect, a bit of an interest rate cut, something along those lines, to just spur a bit of lending back into the economy, get the economy going over again. And so this is what you see. You get this kind of continued cycle. Yeah, you don't see this normal growth path, and this is where you get that kind of cyclical unemployment, because things don't just continue rising and continue in a nice smooth path. The aim is to keep it as close to that as possible. However, that is not always possible. It's just a fact of life that things will not move in an entirely smooth way. Now, if you do want to have a look at a much more detailed version of this, there's a fantastic video by Ray Dalio. Ray Dalio is the owner of Bridgewater Capital, very, very big US hedge fund. So it is market relative. Very interesting video on YouTube. So just click on the link there. It explains everything in the economy in quite an engaging way, very interesting way as well. So I'll let you look at that if you want a little bit of further reading, we should say. Okay, so what economic releases are we concerned with? The major ones that we're really concerned with are the US economic releases. All these figures are released generally on a monthly basis, and the US ones are the big ones. You'll notice this in your trading, that anything that affects the US will affect other markets. This is because the US is the biggest economy in the world. It's obviously then such a big trading partner with many other countries. So everything that happens in the US figures does have a very strong impact on the European and Asian markets. Now, in terms of major US figures that you want to be looking at, it does come back to this unemployment, inflation and GDP. So the ones you're really looking at are non-farm payrolls. This is the major unemployment number in America, and we'll explain that in a moment for you. You've then got GDP release, the ISM manufacturing number, retail sales, CPI. There is another semi-major US figure, but specifically to the oil market. This is the weekly oil inventories number, and we'll also explain that for you in a little bit as well. Beyond there, you've then got the minor US numbers, and these do or can still have quite an impact, but they're a little bit more, seasonal is the wrong word, but a little bit more with the times. So for example, 2007-8 US housing numbers were a very big focus because of the crisis. At the moment, US housing numbers are not really in much focus, and so then the impact on markets and your opportunity to trade is certainly being curtailed there. But the lesser US numbers are ADP unemployment. This is a precursor to non-farm payrolls. You've got durable goods, the housing numbers as I mentioned, PCE, which strangely has a limited impact despite being the Federal Reserve's main indicator of inflation, and you've got the PMIs, the Purchasing Managers Indexes, which come out bi-monthly. You've also got consumer confidence, which is a surveyed figure created from a survey of various people, essentially phoned up to find out what they think of the economy. You've then got other figures which only really affect their markets specifically. So UK figures affect UK, European figures affect Europe. Germany's the big one in Europe, really. That's the one that has the biggest influence. Unless, of course, you get a dramatic change. Of course, if you suddenly see Germany drop into a recession, this is going to send shockwaves around the world, certainly to the rest of Europe, but also its other major trading partners. So the UK could also see quite a big move off it, and it will drag on the US markets as well. So German numbers you want to be watching out for, and UK numbers. UK figures, you look at CPI once again, unemployment, GDP and retail sales, the same as US. German numbers seem to focus a lot more around sentiment. So you've got the ZEW and IFO sentiment indicators. You've then got their CPIs. German CPIs are slightly nuanced in the fact they give a CPI for each state and each region. So the biggest focus is actually not the total German CPI, because you can work that out by the time you've heard all the regions. It's actually the first region to report, and this is Saxony, who report at 8 a.m. in the morning. So Saxony CPI is actually the one to be watching in Germany. I've put together a little bit of a cheat sheet here to just give you an idea of which direction markets or certain markets should move on economic releases. Now, this is not set in stone, and it does matter very much on the business cycle, on monetary policy, on quite a few different things. But in the example, what I'm using is inflation rising, this rising steadily, GDP rising, and unemployment falling. So generally the things that you look for in an improving economy. So with rising inflation, this is a bit of a neither way for stocks. It's not necessarily a big boost to them because the rising inflation can have a negative impact on those who need to buy a lot of materials. However, rising inflation for sales of services is very good. So it's a bit of an in-between for stocks. In terms of bonds, it is generally a sell, particularly in the longer end bonds, as I explained in some of the earlier days. And this for the fact that interest rates are also likely to rise as well. So that's why it's going to be bad for bonds. Currencies, generally good news for, reason being that interest rates are more likely to rise sooner, and that puts a bid into currencies, as we explained on day one. And then commodities as well. Rising inflation, people are willing to pay higher prices for things. Commodities also, particularly gold, is seen as an inflation hedge. So if inflation's rising, gold generally rises with it, so people will put their money into gold so that they're getting over that real inflation impact that we mentioned a couple of slides ago. Now, in terms of GDP, as you can guess, this is good news for stocks, growth in the economy. Slightly bad news for bonds in the sense that what you're seeing is people will move into stocks because in an improving economy, people are willing to take a bit more risk, so they sell out of safer assets, move into more risky assets in terms of stocks. Currencies, strong growing economy, people want some of that currency. Also, chances are if the economy is growing, they're selling more goods, which is creating a demand for that currency, and again demand for certain commodities as well to produce the goods. So rising GDP, generally good for everything apart from bonds, which people will move away from. Lower unemployment, again, good for the equity markets, less good for bonds for very much the same reason as GDP. But also, as unemployment is falling and falling and falling, you can imagine that the economy is expanding faster and faster, and this could have a monetary policy impact. Currencies, once again, this is another good news, very similar to the GDP factor. And again, commodities, because consumption will be rising if unemployment is falling. Now, as I said, it is all about how the economy is performing at any one point. If monetary policy impact is imminent, say a central bank has indicated that they're very dependent on incoming data and that unemployment falling below a certain threshold or a continued fall in unemployment would trigger a rate hike as well as continued increases in inflation, then all of a sudden you get a low unemployment number and actually you won't see stocks rise because it will imply all of a sudden a rise in the interest rates, which will impact companies' borrowing potential. So you'll actually see stocks fall on a drop in unemployment. And all of those other kind of factors, it does all matter on where inflation is. Again, on inflation, on the economy as a whole. If inflation, again, is rising and it's been rising rapidly, a currency may not appreciate in the same way because owning that currency, you're actually losing money by owning it because inflation is so rampant, and so the currency will in fact get sold. So there you go, but there's some generalizations and something you should sort of just have in the back of your mind for each of the figures when it comes to trading them. I'm just going to give you a quick run through of some of the major US figures. I'm not going to go through all the details or spend too long on this, so we'll crack on. Non-farm payrolls, this is the big number, this is the one that everyone watches. All markets are generally affected by this. It's the most traded number really. Can be a bit of a casino to trade, so do beware when trading it. What it does, it covers 80% of the US population. It doesn't cover government and farm jobs or non-for-profit organisations. Within the number, you get the main headline, and this is a net change in unemployment, a net change in jobs created. So at the moment, we've been bumping along around 180, 200,000 net jobs created per month in America. That's the current situation there. You also get an unemployment number, a average hourly hours worked, so this number of hours that are worked per week. So if you're seeing low hours but increasing employment, you're going to guess that a lot of these jobs are part-time and not actually adding quite so much to the economy that you might have thought. And also you've got the average hours, and this is shown as a percentage in terms of how they're increasing or decreasing on the month. And that's been in quite big focus of late because of the movement in US interest rates, which have also been rising. So it's a good indicator of inflation. Next up, you've got ISM, the Institute of Supply Management. This is released on the first day of the month, so it does give you a bit of a precursor to some of the other figures. It's created from a survey of purchasing managers from US companies, and then an index created. Above 50 is deemed as expansionary for the economy, below is seen as contractionary, so you want a plus 50 number. So that 50 is quite key, not just the movement on each month. Also with the number you get an employment element, so that gives you a bit of a clue for the non-farm payrolls that comes out at the end of the first week of the month. And you also then get a prices paid element and new orders, so they're giving you a clue on inflation and also growth in the economy. Next up, you've got US retail sales. This is a percentage change on the previous month of a variety or a great number of companies' sales, just under 5,000. Now, what you do get with retail sales is you get about 4 different numbers. The idea of this is to give a little bit more detail on the numbers. So you get a headline, which is the overall change of all the different goods and companies that have been surveyed. You then get an ex-autos, an ex-auto and gas number as well. The idea behind this is to try and take away some of those large purchases. A lot of cars sold on a month could massively affect the retail sales, just because of the fact that cars are such a big thing to purchase. So you take that away, and also gas, which is affected very much by commodity prices, i.e. oil. They've then got a control group, which again attempts to further smooth this out. So being aware of all the figures is very important when trading retail sales. Next up, you've got the Consumer Price Index. This is an index of a basket of goods. The basket does change occasionally, and you do get some controversy around what's included in the basket. You know, is mortgage interest included in the basket? Is rent or mortgage payments included as well? This way you get big variations. However, that gives you a general idea of how inflation's getting on. You also get a ex-food and energy index. These are the more volatile elements of consumer spending, and so there's the ex-food and energy index. This is known as the core, and tries to give, once again, a more smooth, more clear view of the trend of inflation, as opposed to just getting this jump because perhaps food prices or energy prices have moved based on commodity markets. So that's the reason for that. And again, like retail sales, be aware of both numbers as they come out. Here's how you'll actually receive the data. It will come out at whatever the release date is. This is a screenshot of my Reuters screen. Various different websites will provide the data at slightly different speeds. The 2 major news wires, Reuters and Bloomberg, will have them embargoed, so they'll have the number there, and bang, at 1:30 or whatever time the number is, it will appear in the empty box. Now, the key thing you want to be looking at is the estimated number. It's not necessarily the previous. Previous is useful in terms of continuation and how how certain figures are progressing. However, the estimate produced from various analysts from banks is what you need to be trading off. This is theoretically what's priced into the market. So you've got an estimate, you've got a range as well. Anything outside the range, no one has predicted, therefore it is going to create a bigger move. And then bang, at the time of release, the result will appear in the empty box there. This will be plugged into a lot of computer algorithmic trading systems. So what you'll see is the market will move immediately as the number comes out. If you have a Squawk service, they obviously have to read it and then repeat it. So anytime you hear the number, chances are the market has already moved. So be very aware of that. And this goes into your plan of how you're going to trade it. And I'll explain a little bit of that in a moment. You've then also got the revisions. These usually come out slightly later, but something to be very, very aware of. The market moves one way on the initial release. You suddenly get a revision, which is massively the opposite way. The revision will be in relation to the previous number, of course. If the revision is completely the opposite way, you can see the market very quickly turn back on itself. Quick tip, if you've got multiple numbers, like you can see in this example, I stick a little post-it or a little corner of a post-it right next to the number that I want to be focusing on. So in this example, I would be looking at retail sales X auto as my main figure to be watching for. So you know what the numbers are that we're going to be focusing on. How are you going to trade them now? Now, like any trade, it does need a clear process. You need an approach to trading a number. This will take away the desire to jump in. The markets will often move a lot quicker than normal, and it will feel like you're missing out all the time if you're not getting involved. But if you've got a clear process, you know exactly what you're going to do. It just takes away all of that, and then you wait and you get in where you want to. You do the trades that you want to do. So first up, you need to be thinking about the stage of the business and monetary cycle that we're in. Obviously, as I mentioned earlier, if we've had one quarter of negative GDP, another one could be a very big influence. Equally, central banks are on the verge of changing monetary policy. Again, this is going to influence not only how big of an impact the number's going to have, but also what market you want to be trading. If we're on the cusp of a monetary policy adjustment, then chances are the bond markets are going to take a little bit more impact from numbers than perhaps the equity markets. So have that in mind. Be very aware of the situation, the time of the cycle that you're in. Now, you want to be looking then at market structure. There's no point in, if you think back to the technical day that we talked about, if a market is getting way out of its Bollinger Bands, it's getting way beyond its ATR, you're starting to think it could well have gone a little bit far. You've got to be thinking then, what kind of number would get this market to continue and move that is this big already? And that's what I mean by the market structure side of it. You've got to think about where the market is currently trading. Are there any big levels that it could break? If it does break them, will that create a continuation? So always have that in mind of, based on where the market is, what's the most likely path that the market's going to take, and what kind of figure is going to be needed to send it in that direction. So always be aware of that, and that's going to help you decide where you are willing to get in, and also how long you're willing to hold on to a trade for. And also, of course, if a positive or a negative impact, or a positive or negative number will have a bigger impact or not. Next up, previous figures. Keep very detailed notes on previous figures. This is one of the key things that I learned from very early on in my career. If you've got very clear notes, you can just flick back a couple of months, you get a sense of how the market's been reacting to that number. Is that number having a big impact or not? That's how I know at the moment not to bother trading new home sales, existing home sales, because they're not having a big impact at all. So you can step back from certain trades. You don't need to get involved in all of the chop around because you know how they've been reacting recently. Look at similar numbers as well. The ISM number, for example, the employment element of that, the ADP number, gives you a clue on the non-farm payroll. So watch out for other numbers and how markets have reacted to that. Also, have a very clear idea if your market has certain nuances to it. Does it do certain things irrelevant of what the number is? I'll give you an example. A trade that I look at quite a lot on non-farm payrolls is in the S&P, whatever the first move is, the very first spike on the S&P, if that moves up to a high, it's very rare that stays the high of the move for the non-farm payrolls number. So if it jumps up and starts coming back, I will look to buy it for the break of that high. Now, that may not be a very big trade, but what it is it's something that's quite consistent, and that gives you at least something that you've got a trade on, even if it just entirely irrelevant of the number. You know what a pattern is there. So those little nuances, it can help you get into a trade, it can help you stay in a trade, or equally it can stop you from diving straight into a trade, particularly if you're looking at a fade type trade. So these are the things you've got to start getting in your head. Have a process of it, go through it in that order, look at your market structure, think about how the market used or has traded in the most recent occurrences of this number, anything else that could affect it or could give you a clue to what it's going to be like, and then move on. Next up, you've got to prepare yourself to actually trade it. As I say, I do keep some very detailed notes, and this is what I keep for the Bund, just to give an idea of how much the certain numbers are being watched. So this is for non-farm payrolls in the Bund. What you can see here, you've obviously got the ADP, which is the number on the Wednesday, the sort of smaller unemployment number, followed by an expectation and the actual result. So you can see a few outliers noticeably here, and once again up here as well, where you have seen a big difference between the actual and, of course, the expectation. What you can also see is over time the number has become a little bit less less market impacting. So the last few months here, we're not seeing a big move. So you can immediately start thinking, right, whatever the number is, we're not necessarily going to see an enormous move on it. Beyond that, I then have, as you can see in these two columns down here, I have an indication on what the first spike is. This is literally the first move and how much that first move retraces. So you can see that almost every time the very first move is coming almost all the way back before we then see another break, and that's signified by these Ys. That's another break of that first move. So in general, you can see that that first move does break, so you've immediately got a trade on there. This is that nuanced sense, so that you know that if it pulls back, it is generally coming back almost all the way as well. You can get back in and look for a break of that first move. So we see it, and it goes, it takes out the little break, and there's your first trade. Also, what I have here, scene of the crime trade. What I mean by this is, say the market on the release of the number is, we're saying in Bund trading 161.00. That's the scene of the crime. So if the market goes up and comes back, the scene of the crime trade is to buy it. So you go in the direction that the market first went, and the scene of the crime trade is to buy it at that price when it comes back. And this again shows you what happens if you buy it. Again, you can see that recently, certainly all of 2016, if you buy the scene of the crime, you don't see a great deal of heat. So look, you can have a 5-tick stop and you will not get hit on it. And then this tells you how far it's going. So the last few months, you can see that almost every time you hit the scene of the crime and you're getting, give yourself about 10 ticks target, you're going to get that. So there you go, there is another trade. And once again, we've got another theme going on at the moment, that there is generally a reversal. What I mean by reversal is a reversal of this first move. So the scene of the crime trade may work, but ultimately the very first move will get completely reversed and actually go lower than the original price. So there you go, that's just giving you some ideas and some things that you need to be thinking about as you're trading. So what do we now look out for? Create a plan of how we're going to execute the trade. We want a range of expectations. What you need to decide for yourself is what is going to be an outlier. How far out of the expectations has it got to be to provide a big opportunity? And what you're looking for here, you're looking for the opportunity to hit market, to just get in irrelevant of price and then let it go. Or do you wait for a pullback? What we saw from those that last slide is that whatever happens, you are in the bund much better to wait for a pullback, at least initially. Also, what you need to be thinking about is where's the number in terms of recent years. As you saw in that previous slide as well, the majority of the number, let's just go back a little bit, majority of the time the actual is coming in the high 100,000s apart from one noticeable outlier. So you can see there that on the outlier you also do not get the scene of the crime trade and you do not get a reversal either, so you get the continuation trade on those bigger numbers that are out of line. You also saw it here as well. So that's what you've got. If you do get a number big out of range, then you can just go with it. So this is the key to noticing where the number is in terms of recent highs or lows. And then finally onto your execution. So on the execution, you're looking at the range of prices. Are you willing to get in anywhere? Or is there a certain boundary? If you're waiting for a pullback, how are you going to do this? Are you going to wait? Are you going to say, have a level? And what you're thinking is if the number is positive for the bunds, you're going to see a move up and you're looking for a pullback to the level. You're looking to see buying around here on the level and then a move again. And that's going to be your entry, that continual buying. If, of course, you get that move back to the scene of the crime, again, are you looking for a buy there? Or alternatively, have you noticed that recently there's a fade trade on? If that's the case, again, what's got to be the expectations? If, say, the number comes out in range, so the range is maybe 140 to 250. If the number comes out anywhere in that range, are you going to fade it? And also, how close to the expectation are you going to fade? Say the expectation is 200. If it comes out at 205, are you going to fade it very, very quickly? Whereas if it comes out at, say, 230, are you going to expect the bund to dip, take a level out, and then you can fade the next level, say maybe 30 ticks away? And this is what you'll be able to learn from having that information on how far it likely goes. So say it comes out at 230, you're going to have a go at buying this level 30 ticks away. If you see a little bit of buying there, of course, always watch that buying, and then your expectation is a pullback. So that's what you've got to be factoring in, and also how it's also reacted previously. So once you've got that in your mind, you know that on a certain number, you know that, say, if it does come way below the 140 range and say comes out at 100, you're going to be looking straight off to buy this pullback and looking for a continuation higher. However, if it comes in range, you're looking for this type of fade trade. And say it comes out at 230, you're looking to fade 30 ticks away. If it comes out at 205, you're going to see a little dip, and this may only be 10 ticks, and you're willing to have a go at buying it straight off there and straight back up. So that's what you've got to be thinking about in terms of trade opportunities on the number and how exactly you're going to execute it. So we're going to have a little look at non-farm payrolls. Let's hope I can erase this. Sorry, Johnny, we'll have a cut whilst I rub this out. So what I'm going to show you here is the non-farm payrolls number for the bund in November, which gave us a bit of a clue as to how we're going to trade it in December, and I'll now show you the actual trading video of it. So this is the number. This is on a 5-minute chart, and what you have here is the bund comes straight off on the number, and this is also a euro. So got the two markets there. The reason I put the euro up is because there has been a theme of a fade in the Bund, as we saw from the diary, and also it has been similar in the Bund as well. Also, the first 5 minute move is not exceeded. The first 1 minute one is. So there you go, you've got a double trade there. You know that the first minute is going to drop, pull back, drop there. At the end of 5 minutes, this low is not getting retraced again. So you've got two trades there, and you also know that the reversal is on. So you've got the first minute, 1 minute, 5 minutes, and then you know that the reversal of the whole move is on at the moment, and so that's what you're looking for. So that's what we saw in November. That has given you a clue. It is also not moving a great deal of distance, so once again giving you a clue if it's quite close to the actual number. Having looked at the November number and also knowing what we know about how the Bund's been reacting generally to payrolls, you can start to plan for the December number. I'll show you the chart, and then I'll show you the ladder video of how it traded. So first things first, structure. Look how the Bund has traded coming into this number. It's had a big drop, dropped around 250 ticks, highs to lows. The morning prior to the number, just here, Bund's had a little bit of a bounce, bit of consolidation. So what you've got to be asking yourself first up is, what has got to come out to get the Bund to make another leg down and break these lows, bearing in mind at how far it's gone so far? It's going to have to be a very big number. So with that in mind, you're thinking, right, where would I be considering a fade on this number? If this is a little bit of a beat, would you be buying it down here at 91s, this area down here? Equally, if it is a small miss, so you'd expect a bit of a rally in the Bund, what levels would you be looking to have a go at fading it if you're looking to play that fade trade? You'd be thinking, right, you've got this first small level around 46s, this sort of consolidation, up to 50s, this peak of volume here. So that's going to be your first area you're looking at. It's going to have to be quite a small number to do that. Beyond there, you're then looking up towards these 75s, that previous low and high there. So they're going to be a couple of areas you're thinking about immediately. So that's what you've got in mind structurally. When it comes down to the number, we do know that the very first spike is usually taken back out. So whatever it does on the immediate jump up is likely to go a little bit higher. However, we then recall that the first 5 minute candle, so the actual first move, is usually retraced entirely and actually goes lower. This candle here is the move in the first 5 minutes on the Bund. So what happens is you get the spike up, the spike starts at around 31s, you get a quick jump, pull back, and then you know on that pullback that you're likely to see a new high. The number's virtually in line, so fading it quite early is valid because there is no real reason for the Bund to move away from the current prices it's trading. So with that in mind, you're then thinking, right, as soon as we've got the first 5 minute high in, it's unlikely to go back above it. Again, you see the same in the euro, which is something that has, again, been very familiar. Once you've got it, you get the chance to take the trade on and look for a new low and a move back down through the initial move up. You've also got the scene of the crime trade on. In the second candle, this doji candle, note how it comes all the way back to the opening price before having a bounce. It doesn't necessarily make a new high, as you can see. It's not been doing that, but it gives you a bounce, it gives you a few ticks of trade. So again, if you're trying to hold on to a short, keep that in mind that it will usually bounce off the scene of the crime. So if you're not playing that as a trade for the long side, just be aware if you are short, you're unlikely to just drop straight the way through it. So that's the way you need to be looking at it. Very in-line number. The only impact really is this lower wages element. So inflation lower, and I do think that's why eventually we did get this turnaround and then a secondary reversal higher as they're playing on the wages, the inflation element of the number. So that's what we've got to be thinking about. Remember these numbers. I'll show you the video just now. We start off around 31s, we jump up to 45, 46 area. Remember, you'd be happy selling it up until this, at least until it gets above that high volume at 50s. And then, you remember 31 is the opening price, the scene of the crime trade, 46 being this little level over here on the 60-minute chart. So keep those two levels in mind, and we'll go and have a look at the video and see exactly how it played out.
We'll just point out a couple of things that you want to be looking at. The Bund is the market we're going to be trading on the right, but also do keep your eyes out on the euro. Reason for this is they move quite similarly, the Bund and the euro, and as you start seeing a bit of pressure in the euro, that gives you a bit of a clue on the Bund. So let's go for it. Listen out to the squawk, how much info he gives to you. You've got to drag out the most important bit and then trade straight off that. So let's go ahead.
178 compared to 175. Average earnings minus 0.1. Unemployment rate 4.6. Private payrolls 156. Hours 34.4.
There we go. So we've had the average earnings as well as the unemployment rate, and the big number, obviously 178. We got in very, very quick. Now remember, that first spike is unlikely to be taken to hold. Yes, we'll get a pullback, but it is unlikely to hold. So whilst we've got in very early, we are going to need to take something off because those 40s are likely to get taken out. Note how on this first dip, we only get as far as 31. That's that scene of the crime before we then go and have a little bit of a look higher. It's a little push through 31s, but again, if you were looking at this the other way around, to be buying that scene of the crime, you would be doing all right here, getting in at 31s. Yes, you're offside a little bit, but remember, your potential's up towards 40s, and we do start seeing that turnaround. So two ways of playing the same trade really. You've got the fade on for one, but you've also got that scene of the crime, and we now start seeing the Bund starting to push higher. Notice that euro is moving up towards 106.70s, and we start pushing up. Now remember, we said earlier, we'd be happy to sell the Bund on a reasonably flat number as long as we didn't get above 50s, that high volume node. So we're not quite getting there. We are still maintaining a position short, yet it is ticking offside, but like I said, we've now gone through that first spike. It's now a case of, are we going to get this pullback? Euro once again struggling around 106.75, and the Bund's holding up that little bit higher. Notice the euro is still struggling as the Bund pushes on higher. This is telling you that there is potential for a little bit of a turnaround. We start to see it now. It comes back off those 45, 46 areas, and we start to drift a little bit lower. Notice the euro is down at 106.70s now, holding again, a bit of size coming into the Bund. Even the fact it's gone bid at the high, can't get it to come off, and now there's a chance to have a go at a sell. And we start coming off quite quickly. Once again, back to that scene of the crime, back down towards 31s. Keep in mind all the time that usually that first move up, that first 5 minutes, does eventually get reversed as well. So we are still trying to maintain a short position. It is a case of you've really got to manage your positions, particularly on these numbers that are not that far out of line. You're going to get a lot of chop around, and we're now able to get a bit of the position out. Once again, spiking high, you can now reasonably confidently have your stop above 50 and be ready to try and run it back down towards those previous lows, down towards those 26s, which was the lowest that we actually got on the pullback. And we are now seeing that. We're seeing the Bund come off. We're getting around 39s, 40s area and just holding. You can see we're continually having to work this trade though, up around to the mid 40s again before we come off. Sold again at around 43s, just taking little bits of profit before we're waiting for that actual proper push back down. And here we go, we do start to get it a little bit back towards 40s again. So even though you're waiting for a trade to play out, you still have the opportunity to play these smaller ranges, selling 43s, 44s, being able to get out around 40s, 39 area. And so it gives you an opportunity to manage that position. Notice how our average price has also moved up now from 31s up to 41s, And this has just been a function of getting in and out of little bits, waiting for the move to come off and maintaining that stop. You know where the stop's going to be, and so until you get through there, you know that you're not entirely wrong. Once again, the euro is having another little push higher, but once again the euro is struggling on that push higher around about those 106.70, 75 area, and the bund maintains into the mid 40s. We are still thinking, well, we could well see this turnover then after that first 5 minutes and a move back lower. We do eventually start to see it. Here we come, we added to the trade again, and we are starting once again to come off now back towards those 40s once again. Notice that the market is not able to push much higher now. You are starting to see some of those offers hold around 42s. Little bit of absorption at 41s. Euro still coming back off towards those 60s. Once again, we hold the 41s, but we are seeing a bit of offer coming in at 42s. And then the market breaks the 41s, breaks 40s, hold them a little bit, and now we start to come off. And this is where you get that rotation back much lower.
I've got an example here of why market structure is so important coming into a number. So it's a German ZEW number. So obviously we're going to trade this in a German market. This is the DAX. What we got in the DAX is you got an inside day just here. You then had a breakout of the inside day which failed. You got a close lower down here. The reason for all the annotation, this is how I do my debriefs, this is how I look back at the day and sort of figure out where I've been doing the right thing, how I should have been looking at the market. It gives me ideas for further trades in the future. So we've got a low close after the breakout that failed. So immediately we are thinking, right, the market should be going down today. What you would want to see really is a retest of the close, also a retest of this very prominent VPOC as well. What we got, in fact, was not that. We got straight selling straight off the open, and that took the market lower. What worried me about this move straight down is that the delta didn't continue falling as the market continued falling. So on this secondary low here, what you'd want to see is the delta decrease. What this means is more people are selling at market to get the market going lower. We didn't see that. What you were seeing was actually more buyers were coming in. So the selling was very passive. More buyers were coming in, and so you needed to see this delta continue falling if we're going to get any further drops. We did get down to a level 106.32.5, but that's not necessarily a reason to buy on a day like this because it is a very bearish looking day. Now, ZEW number comes out minus 0.5. It was expected a little bit higher. If the market's going to continue this move down, you need to see some selling on this number. We didn't see it, and what happened very quickly is as soon as we broke this downtrend, just on this candle here, we got a very fast rip up, and this is where everyone who got short early on gets caught out. You get the rush higher, and then as soon as we hit that VPOC, get through this close, we hit there and we start coming straight back off. This is very, very clearly a short squeeze move. And it's all happened because the market got too short too early. Couldn't get any more sellers coming into the market. They were very weak shorts that just went for it very early. They then all got caught out. Being aware of structure gives you a very good clue on this. Like I say, because we opened lower, didn't test back up to the close or the VPOC, then that tells you there's a possibility that this will still get retested during the day. It's exactly what we saw. And as soon as it was hit, as soon as you got that flush up, it then sold straight from the VPOC. As you can see, VPOC was right there. If you sold it, you then got the drop, which came pretty much all the way back. And as is so often the case, you got the scene of the crime trade. And if you bought the scene of the crime, you once again got a little bit of a bounce in the DAX. So a few trades to be looking at. Seeing that the crime trades do work even a few hours later. So there you go, an example of how market structure can give a very big move off a reasonably small number.